Hello, folks. Thanks for joining us tonight. Thanks, Ali, for that amazing introduction, as well as to Carolina. Thank you for hosting us this night here in the meetup of New. So I'll start very briefly introducing myself. Well, as you can see it in the screen, my name is Jacob. I've been working here at New almost in the same period as Ali, almost 3 years since I graduated from studying actuarial science in the University of my Mexico state, the Estado de Mexico. And I joined New just when I graduated from DS, starting as a junior data scientist, now a senior data scientist. So far, I'll say that it's been amazing to work here with such a large pool of talented people, and that's always challenging the status quo and always looking for the best proposal for the products that we deliver to. So now I'll handle the mic to Jose.
Oh, hey folks, I'm Jose. Jacob, I'm also a senior data scientist here in Nu, also working with credit limits. I've been working at Nu for about a year and a half now. And before I studied mechatronics engineering, and when I was doing that, I got in contact with machine learning. I started liking that a lot. So then I started working as a data scientist. I used to work in consultancies before, and then I wanted to work on something more focused, and I got here in Nu, and I've been loving it so far. So with this out of the way, we can begin the proper talk. So since most of you are here, you probably already have some context about what is Nubank and what we do, but just to give some context for everybody. So we've been working with the mission to empower people and also reduce the complexity of their lives since 2014, in the financial system. And throughout that time, we have grown a lot. So at the moment, we have more than 114 million clients, which is a lot of people. And this also places us with a happy problem because we have so many customers that we have to serve. Then we have to do so in a smart, scalable, and sustainable way, which should not only encompass a technical perspective, in which we have the capacity to be serving these people every day as they need, but also from a more holistic perspective, we also care about our clients' financial lives. So we also have to take this into account for a problem. So as you might imagine, doing so requires a lot of moving parts. And in particular, we're going to be talking about a risk for the credit limit problem. So giving you an overview of the talk, first, we're going to give some a business context. So just explaining in general what the credit limit problem is. Then just give some insights into how we can model risk and how we do it in particular in our team for the limit increases. And then we're going to talk about how once we have a model, we actually do so trained in scalable ways and also work in scalable ways, not just to handle large volumes of data, but also to leverage the different working flows for different countries, because we have we not only have Nu in Mexico or Brazil, but we also have it in Colombia. So we want to leverage our work as much as possible. And in the same vein, we're also going to be talking about how we can deploy the models and actually operate them in a healthy way and be monitoring them successfully throughout their lifetimes. And after all of that, we're going to have a Q&A session. Okay, so just to place us better in the context, here at Nubank, we have different ways and different products in which we can approach risk. So for example, we have the credit card underwriting problem, in which we have to decide if we which clients we want to give a credit card or not. We also have other loan products, for example, personal loans. But in particular, we're going to be talking about a customer management problem, in which we are just focused on current credit card holders with us, and just how we can be giving them limit increases. So recapping the limit increase problem, the way a credit card works, I'm sure most of you are familiar, but just going over the workflow. A lender, in this case, us, Nubank, gives somebody some limit. Then with that limit, the people can make purchases for services or transactions. And once these purchases are done, Then whoever they bought something, they send like a bill to Nubank, which then pays the bill. And at the end of the month, like Nubank sends like a bill to the customer, and then the customer pays the bill. So in this workflow, we can see like two key things. Like on one side, like the end, like credit card is a loan. So we are always at risk of like the people not paying us back. And on the other side, based on the limits that we're giving people, it's how useful, yeah, how much use they can take like out of the product, because it basically caps like the things that they can purchase. And in the same side, it also affects how like profitable the product can be for us, because by using the product is how like we can like be earning money from that product. So as you might see, like setting a limit is not like something like very straightforward, and it's important to find like a right limit, because also like if we just give high limits to everybody, then we can push some people into like an unhealthy financial situation by allowing them to like overspend more than they should. Or we can also just like expose ourselves more to like huge losses. And if we just give like low limits to everybody, then we are giving like a product that is not like very useful. So that also like affects the clients, makes them unhappy, makes them like look for other like banks, and then we lose clients, and then yeah, the company doesn't like work. So it's important to find like a balance for like these two things. And something important is that we don't have to have like a global like limit for everybody, because everybody has like different like spending behaviors and also different like risk profiles. So based on these things, we can like settle on which like a limit we actually want to give like to specific people. So here at Nubank, the way we do this is basically like yeah, like our existing customers like use like our credit cards, then they generate some data. Then based on this data, we process it, and we have like several components that we use in what we call like the limit increase policy, which is just like yeah, what we use to decide to give somebody like a limit increase or not. And in particular, for the risk components, we have like the global like a risk component. We just think about like the probability of somebody not paying us back. Then we also have like another like a risk component, which is called like the severity one, which is okay, like maybe you are not going to pay us back, but how much money we are going to lose based on that. And we can also look at this like I don't know, like divided by over the limit. So this is called like the severity. And we also have like a second type of risk, which is like the second order risk, or the risk given a limit increase, which is basically, okay, so we gave somebody like limit increase. And by doing that, we change like we allow them to change their behavior, because now they can like spend differently. And this like places them like in a different like risk setting. So we have like all of these like three components, but in particular in this talk, we're just going to be focused on the first component, which is like the probability of not paying back or defaulting. Oh, and just to like give more insight, like when we mention defaulting, we mean that like delinquency, which is when somebody doesn't pay us back. But it's not just somebody doesn't pay us back for like one day. It's for like a specific number of days. It's usually recommended to think of defaults like between 60 to 180 days, depending on your business needs. This is mostly tied to like the probability of somebody, once they reach like that amount of days, like actually not paying you back, or also like how much like interest you can charge like during that period. But basically, the default is that specific kind of like a delinquency in which we consider that a loss is just going to happen. And other concepts that we might mention from the talk are, for example, things like tenure, which is just like how old like people are yeah, like in their like a credit card account. So now we're going to be focused on how we can like actually like model like this risk problem. And at its core, it's just like a binary problem in which we want to predict if somebody will default or not after once we take like a decision. Like this is important for like for the perspective of the limit increases, because we have the opportunity to think about this question like in more than one like a moment in time. For example, when you're like in the underwriting side of things, if you think about giving somebody like a credit card or not, once you give the decision like it's done, but also like yeah, like you just have like the client for like that window of time in which they want to become like the client. And in their scenario, we can like go back to our clients like more than once like over time. So that's like important. Like we're not like stuck like in a single like a moment in time to make like our decisions. And also something else that happens is that once like somebody defaulting is not something that we just think about like they will default or not, but we also care about when they will default, because it's not the same if somebody's going to default like in 1 month or if they're going to do so like in 2 years. And this also brings us to another problem, which is like the more we look into the future, the more like uncertain things become, because the people's behavior can change, like also their situation, also like the country's economy and things like that. So it's also like important for us to try to keep like an updated view as much as possible, like when we think about like this like risk modeling, and also to take like the time of things like into consideration. So just thinking about like a yes or no question doesn't give us like a very robust like a framework. And to think like on a more like a like flexible one, we can take the approach of like a time survival, in which this like a modeling approach, basically what it does is like instead of thinking of if somebody will default or not, we're actually thinking more about like when a default will happen. So what we're actually trying to model is just like the time until somebody defaults. And with like this comes like from some like probability distribution that we might like assume has like a shape or not. And then basically we just like build like a if we build like the cumulative risk of somebody defaulting before like a certain time, we get like this like a monotonic like increasing curves, which we can like actually think about like a modeling, and then we can go back like to our like a probability setting problem, which can also like help us plan our decision making by having like a like different like thresholds for us to like think about. And another way to think about this problem is like not in the cumulative risk like a point of view, but in like a survival function, which is basically just the inverse of this. So the question becomes like instead of if somebody will like default or not, if somebody will survive or not, which in this setting surviving is like not defaulting. So as we mentioned before, we have like the delinquencies. So just to explain like a bit how we are like actually building these targets, like every time we are going to make like a decision, we build like a window into the future in which we think of in which we look at the time until somebody is going to default or not. And then based on that time, we just have like that time for like the different decision like periods. So here, as I've been like mentioning, there's no like a single decision time. So we can like go back to the same person like at different points in time. And then what just happens is that the time until default is going to be shortened like every time if they are going to default. And we also face like a different problem, in which is that we are always having like some sort of censorship, because like in theory we can look at like this like survival problem, but in practice we are only observing like a default event. So if somebody hasn't defaulted yet, we can like we don't know if they're going to default like I don't know, like in the next days after we finish like modeling this, or what's going to happen like in the future. So there's like this like uncertainty and censorship like involved in the whole problem that we have to take into consideration when we think about it. And just like tying this back together to the like the commodity like risk probability, if we just focus like on a single like decision time, in this case like the first one, and we look at many different like accounts, then we can build like a probability of default like for those ones, for the different like moments in time that they're going to default. So we can have like this like for the different like moments in time after the decision, and think about when the defaults are going to be happening. And then we can actually like update this like for different like decision times, and then we can have like a bunch of different like survival curves or like cumulative probability curves that we can like be thinking about like for like a modeling problem. Now Jacob is going to explain more how we can actually like start like feeding like these kinds of curves, and not just like build them from like observations.
Yep, that's it. So thanks, Jose. I think that was a cool introduction to the new situation, the credit card product, and basically like the basics and the theory of our problem. Now let's get into the details of how we can actually get to these predictions, right? How can we actually estimate this for the accounts? So basically, we can start from the basics of this, and it's just by starting with the basics of the idea. And this already starts considering, for instance, non-parametric models. That ideally this type of models solely rely on the straight data, like getting to know the details right from the data, like avoiding having methodologies, just go and see how the data looks like. Ideally, what we need for this is just to have these records of observed time to default by keeper, in this case by account, and the decision time that we are interested into, but also considering additional groups of interest. For instance, I don't know, like the age being the utilization of a credit card. That utilization just stands for how much balance are the customers utilizing of their entire limit, and we could ideally just fit some straight curves from these groups. This would already give us some additional insights on the proper portfolio behavior. But most importantly, is that this type of methodology is distribution free. Is that we don't have to assume anything. We can just get the the behaviors from right from the data, and that should be it. But this type of methodology can bear some main disadvantages, and the first one would be that this type of modeling is not scalable. Why? And it's because we have to consider that we are fitting a survival curve per group. So for instance, assume that you have 4 variables that describe a population. Each variable has 4 categories. Then you will have to construct 36 variables that then might not be the best variables and might not explain the entire behavior of our portfolio. And this leads to the second disadvantage. And that's that this type of modeling is prone to overfitting. The reason of this is because we are just trying to fit the entire problem on certain variables and certain categories. This will ultimately lead us to producing very poor estimates for individual risk timelines. So ideally, this is not a not a good fit. Also, as it is also listed here, this type of methodology cannot handle covariates directly. And by covariates, I refer like features or variables, right? We have already assumed that we can group customers and then fit a model per combination of the group. So this is not ideal, and therefore we can also try to consider other methods. For instance, the parametric models that, again, like we just start with our table with our actuals. That's just the observed time to default. And for that, we need to start assuming certain probability distributions. How this works is basically we just take a look at of how our actuals look like in this graph. You can see that there's this empirical curve that is just the curve that we get when we compute it from our actuals. And the idea is that we can find a probability distribution that better fits this data. But there's like some challenges on this, right? But even if we found the best distribution, then we would also have to fit with covariates or consider additional features, because again, like one single curve cannot explain the specific behavior of each customer, just like the entire portfolio behavior, right? But like particularly the main advantages of this is that, again, following this type of methodologies, we would have an unbiased and consistent estimator. And by this, I mean that it's an estimator that possesses some good probability attributes. And for instance, it could be good for individual risk scoring if we were able to find the right distribution for each customers. And secondly, it's very highly interpretable in the sense that, for instance, if we were assuming that our portfolio follows an exponential distribution, if you're familiar with this, the parameter of the exponential distribution, it stands for lambda. And for instance, the mean of this exponential distribution over time represents like the expected time of default or event. So we could get like this type of insights, but ideally, we are not very interested into that because we are more interested into the actual predictions, right? But what are the cumberstones of this type of methods is that, again, we have to assume there's a sole distribution, or perhaps that each account has a different distribution. And this could lead to mismatches or biased estimates. For instance, I like to exaggerate on this image. Like, for instance, assume that we only have a certain amount of data available up until this cutoff orange line. So for instance, on this range of data, we could assume that, for instance, a Pareto is the best fit. But when we start uncensoring this data, we just found out that it was not the best choice, right? So this is also one thing to consider, that this may lead to biased estimates if we don't have like enough data to validate this assumption. Secondly, it's often too rigid to capture heterogeneous behaviors. Again, like we can assume there's like a probability distribution that fits the entire portfolio. But again, like not all accounts behave the same. So for instance, one distribution cannot fit them all. So that's one thing to consider. And for instance, it's harder to model non-linearities with this type of models. The thing is that like current methodologies, well, not current, but classical methodologies rely on linear interactions in that. So this is not ideal. So now let me introduce you like what's our actual strategy on this and what we call our base ingredient in this presentation. And for that, we follow the idea of dividing and conquer. So what's actually the purpose of this is that, okay, we know that people possesses different risk levels. And for that, we can split the problem in two parts. Here, first, we can consider that um, people have certain people will have certain levels of risk than others, and we can first consider this problem as one, and then later we can focus on actually predicting the right risk predictions for each account or group. So what's our method actually doing is, okay, first we're going to have a risk level prediction. That means that we're going to have a robust signal of risk. And then we can later perhaps group these risk predictions and create this group level that can already have a strong signal for us to estimate, for instance, a non-parametric model. Then we might select some covariates that will lead us to have a final calibration of this curve. And for instance, well, and finally, we can later have this final risk curve prediction that ultimately has the benefit that, okay, since the process is split in two parts, we can ultimately have a sole fitting process for this, and therefore we can update this risk curve fitting like many times depending on certain situations, and we don't have to update the risk level prediction at the same frequency. We can do it in independent ways, right? So, and additionally, one thing to consider here is that the risk level group here, I'm taking this with an asterisk because depending on the situation, this can be an optional step. But practically, this is like our base solution, and our base ingredient is the risk level prediction, right? So how does this risk level prediction is actually working, or what's the idea behind this? Well, considering the methods that Jose already explained, it's the idea of, okay, instead of focusing on predicting the entire risk curve, what if we just focus on one single point of that curve? We don't care about the shape. We just care about producing a risk signal that already tell us that perhaps a customer is riskier than the other at certain point, and therefore their risk curve later can be uh, better fitted depending on this initial risk signal, right? So the idea of this is that, okay, we're going to predict the default, but just for a certain window period after the decision. So in this case, we can see in this plot, there's like this window. So we are going to observe the behavior of the account for just this window. So in this case, the decision is after the decision, or well, at the decision scoring, we are seeing that on the window period, the account hasn't defaulted or hasn't started a default. But in the second scoring time, we can already see that the window has already entered or captured the start of the default. even though this doesn't capture the exact default event, this can already, it's like a trick that we use to already tell the model that they should already pay attention to. So this is kind of like one of the things that we do. But additionally, we have to like keep flagging all the scoring moments, right? For instance, here it's the defaulting, and that ultimately leads to having target data set that labels the yeah the targets with one, but just on this window period. So the idea of this again like is to have a single prediction that already give us the signal but not the shape. And here you might think of, okay, but what's the correct time window that I should focus on to predict? And basically this depends on your use case, because and well your use case and your actual in the situation that you are currently in. Because, for instance, you might say, why not like predicting at a shorter level? The thing with this is that mm, on a shorter period, you might uh, still have a risk signal, but as this at this moment, people will have would have or not have past its inflection point. So in this in a shorter window, people could have a risk that ultimately at the end of its curve or on the longer on the longer period, it might change a lot its risk behavior, right? So ultimately, you might think then that we could push the threshold towards, I don't know, like well, not infinity, but to a longer time of observation. And the thing with this is that, I mean, in this, you can already see that perhaps on with the blur, the curve is already like not changing its shape. But ideally, we don't know about this, right? Perhaps the risk curve of a customer has many inflection points. Perhaps we have already passed it. Like things can change, and ultimately this could be better, but this has some trade-offs that we have to consider. And for instance, is that the longer that we estimate the risk of an account, like for instance, in this case, I don't know, like we try to predict the risk of defaulting of an account on the next 20 months. Well, you have to consider that once you predict, you have to wait 20 months for you to know the real value of your target, right? So this is already some trade-off that we have to continuously evaluate on. Like perhaps we need a shorter target for certain business use case, or perhaps we want to have a long-term risk prediction. But ideally, we also have to account that our portfolio changes constantly. So ideally, we want to have a threshold that accounts for recent risk changes in the portfolio, because I don't know, like new acquisitions, the macroeconomics of a country that produces riskier people or lower riskier people. So uh, on our experience, finding the right spot of this is the best. Not always accounting for the long term, neither for the short term. So once we have this, it's now a thing of how we evaluate this model. That's ultimately just a classification model. Well, it's a classification, but we are not interested actually in if it is classifying correctly, but rather on ranking. Remember that we want to produce a ranking score that later will enable us to fit the right risk curves, right? So on this case, even though it's a again like a classification, we are using the ROC AUC, but on its ranking interpretation. And for that, you can already see here that the AUC can stand for the probability of the score of a target one being greater than the score of a target zero. So that ultimately will tell you that your model is ranking correctly or not. But we also have another way to evaluate this, and it's by the risk ranking curves that ultimately will tell us if we are sorting the customers by risk score correctly, right? So let's just consider this plot. So in this plot, what we're considering is that on our evaluation, we are seeing a default rate of 15%. That means that 15% of the population that we're evaluating is defaulting. And on the x-axis, we are ranking the customers from the least riskier to the high riskier. In the perfect scenario, we would be ranking 80% of the population on the left side and the 50% of the ones that will default on the right side, right? So now if we train a model on this, what we can see, here I'm putting two models, is that one model could rank, like in this case, just a linear sloping that's uniformly increasing the risk. But there's the model two that, for instance, is ranking better the customers because it's producing lower risk rates as we are accumulating population, right? But the idea of this is that we we um, we move or have a model that's more leaned into the perfect scenario. And yeah, that's mainly like the purpose of this type of evaluations to assess that the model is correctly ranking and that's reducing better. And for that, we are continuously improving, versioning the models, improving with features, and so on. And an additional stuff that we can do with this type of curves is that we can ultimately have some interpretations for business. And for instance, here, if we check the 70% of the population, we can see that this at this level, for the 70% of the less riskier population, we are reducing the risk by 50%, you know, because here we are already computing a risk rate of 7.5%. That's compared to the 15% on a random scenario. It's already good, right? And finally, just to finish on this, okay, now we have our risk signal, and then we still have missing the risk predictions, right? So let's just recap. We have a risk model, we have that produces a risk group, risk score, and then we later can create, for instance, groups that, for instance, can later be used for a non-parametric curve with additional covariates, or for instance, a parametric curve with covariates. And ultimately, in the case that we already have enough data and confidence to use or assume a distribution, we can ultimately go straight from the risk score as an input for a parametric curve that could be estimated, I don't know, with better methods than just the classic ones. So just to have this more visible, or yeah, to exemplify this better, let's just consider the idea of the non-parametric curve that's being fitted using the risk score. So on the risk score, we, for instance, group by beans or levels of the risk prediction. And for that, we already can produce separated risk level curves, because ideally we have already estimated or ranked well our customers to produce these well-splitted curves. But even though these curves can already be fine, inside each group of risk, we can still observe many variants. For instance, I don't know, we already have a risk score, but we have seen that, I don't know, gender or age, or I don't know, other type of variables are explaining risk inside a sole risk band. So we also have to account for that, for not just to have these very non-granular predictions. We also have to account for additional variables that explain risk, right? So going back to the initial statement that Jose made on this problem of the limit management, ultimately this risk ranking model and the curve enters like this. So now we have the risk split it in two parts. The risk ranking model fits the risk curve, and ultimately the risk curve serves as an input to estimate the losses, but also to estimate, for instance, the risk given limit increase and perhaps other components. But the risk ranking model, as one of the benefits of having this the problem divided, is that ultimately this serves as a signal for, I don't know, the severity model or other types of components that we have on our policy, right? For instance, I don't know, spend, interest, or whatever other component that we have on our policy, right? But also, not just we cannot just enclose the use of this model into the limit management policy, but also for other new processes, right? Since it is a robust risk signal, this can be fitted into other processes that maybe get benefited from this. I don't know, like decisions, experiments, I don't know, whatever uh, decision that wants to leverage on risk signals can also reuse this, and that's one of the benefits of our proposal. So yeah, that's mainly it. Now I'll pass the mic again to Jose to talk about additional stuff that we have.
Oh, thanks, Jacob. Okay, so now we have seen like a bit of the context and also how we can like frame the problem and actually model it. But now like it doesn't like just like die with the model itself, because there's like a whole process that is happening like all of the time. Because for example, once we have like a model, we also have like other like key challenges. For example, we can have like a model degradation, because as Jacob mentioned, like our portfolio can change like over time, like especially in more like in less mature countries. So I don't know, like in a country that's like just like starting, maybe like as we launch like new products and things like start to change, then we start like attracting like different people. Or if you have like a country like Brazil where we have been like operating for like more than 10 years, then maybe that we already have like a more mature like customer base, so it's like a bit more stable. But we have to take like these things into account, which can like affect the performance of the model like over time. And yeah, then we just have to like keep on monitoring the model and also assess like when is the right time to actually like change it or update it or do something like about it. And these like changes also happen because of our own products. I don't know, like we launched a new product, and like we can have like a cross selling like between our products, or then people like stop relying like as much on the credit card and start using like other stuff that they were not that previously using. So we have to like keep track of these things also like all the time. We also make use of like external data, for example, from bureaus in different countries. And this is also a challenge that we have to be like on top of, because even like if this data is also useful, it's some data that we don't have a control of. So I don't know, like maybe they're going to change like a yeah like a product that they previously had is going to get deprecated, or maybe as time goes on, like a previously very strong signal that we used to have is not as like strong for us, and we can replace it with internal data. So it's also like something that we have to be like assessing like constantly how to do it. And as you might imagine, this is like very like country specific. So also like different things going on in the countries can like affect the models. So to like overcome like these challenges, we try to have like a framework that allows us to like iterate like fast and also like efficiency, and also to leverage like different things for different countries, but not just have like the same thing for all countries, because they are like very country specific things. So we try to have like a balance between like having things like are like very reusable, but also flexible enough that we can just like make things like yeah like as particular as they need to be. So for example, for the features like the internal and external like behaviors that we want to capture, they depend like a lot of countries. So we have like a common feature store and different like frameworks for also like interact with the data, that so that if we have to work in different countries, then it's easy to just like move between contexts. But at the end, like everything is very like country specific on the data that we have. We can also like leverage different products for that we have like yeah like in each country, and depending on the how much volume of data that we have like in different countries, and also like the maturity of the countries, this also allows us to experiment with different stuff. For example, we are experimenting at the moment with like foundational models, and yeah like these things are some of the things that we can be doing. So just to give you some context about the foundational models, because it's a very hot topic at the moment. So here are like some blog posts that are like teammates Hiroto and Daniel have like written. So basically the idea is that since we have like a more than 114 million customers, we actually have like trillions of financial transactions. that we can be learning on top of. And most of our approaches are like based on like very like tabular like models that we know are like very robust and reliable. But we are now exploring like more like raw data and how we can leverage like all of these like transactions, and are doing like some experiments on top of that at the moment.
Right. Okay. So yeah, that's pretty much like a recap of like the main issues or that we have to face for the model, like either for the target or the features. But we also have to consider there's like certain dynamics that we have to consider based on the country scale that we are iterating on, right? For instance, a Brazil data set is like huge compared to, for instance, the Colombia data set that because they have customer bases that are like already uh, big enough or small enough to fit for a specific tool or not, right? So, for instance, we currently rely on Spark and Python based models. For instance, a Spark model might better be fitted for a huge data set, but we also have to consider that this might not be the best use case or either on the size of the model and also the cost related to it. So, for instance, we are still like attached in some cases for just the usual libraries like GPM. But as long as we also try to iterate for innovative approaches and so on, we might also have to consider stick to Python, but with other types of architectures. But this comes in the head comes with hand of having a robust engineering practices that allow for that for continuous iteration and development that ultimately can guarantee that our logic and our code is production aligned from day one. So to avoid having to present stuff that in the end might just be reproducible inside a notebook, we try to avoid that as much as possible, and therefore we also rely on these continuous integrations and develop and deployment checks. We also have we also have to rely on the reusable feature store to have things validated in production. And well, in the end, it's just about promoting code reusability, traceability, and governance. So that's one of the good things that we have. But again, like this is not only about the model development and that we also have to care about the execution of this, and for that we have to have in mind that the decisions we made cost well have some inherent cost, right? And for that we need to have a reliable model execution with continuous oversight. For that we rely a lot on our data execution pipelines that guarantees this scoring jobs being scheduled and that they are being orchestrated correctly to have consistency. But not just that, it's about like actually monitoring this, like monitoring that our definitions over time are consistent. That, for instance, a code migration doesn't break our model features, therefore our model predictions. But not just that, we also have to take care about the I don't know concept drifts, portfolio drifts in its behaviors, because again, like, and this is related to the problem that Jose mentioned about having continuous risk that we are tackling on, and also about the data landing times. That's kind of like related to how efficient are we are and how aware of the money that we are spending on. But ultimately, and most important actually, is the performance monitoring, right? We also have to keep track of the predictive power of our models. It's not, again, it's not just about the model development, but also the performance monitoring. And for that, we rely a lot on these alerts for underperformance or anomalies that occur on the daily basis. So, recapping, initially we started the presentation with this question of how can we grant limit increases on a smart, scalable, and sustainable way. Well, practically, it's about first of all having in mind that we pursue always simple but robust methodology. That's our priority, but that doesn't stop us from continuously looking for improvements, innovation, and adaptation to newer technologies. We are not just reaching to the methods that have served our foundations for each country. We are continuously iterating and improving that. Well, that's just related to how different countries require different solutions. For instance, Brazil is a country that's hugely developed in contrast, for instance, to Mexico or Colombia. And for that, we have to have in mind the cost, the efficiency of our solutions, right? And therefore, it's not only about the model and the methodologies, but also the execution on that. And I'm not just talking about the development execution, but also the production environment, right? So that's something that we need to have in mind to scale stuff. It's not just about scaling on data sets, but also scale on terms of cost and for instance, delivering the correct solutions, right? And in the end, this ultimately leads us or converges to being sustainable. Again, we are a company and we are always looking to be profitable. So this is already linked to the other points where we're trying to be profitable in the most smart way, with the most efficient way, the cost reduction. But like overall, we also have in mind the sustainable social impact that we have that's related to the financial inclusion and financial health that our customers should have, right? So I think that's it.